Hey everybody, this is Dr. Duru of the Market Breadth featured on 122. Crazy day in the market. This is March 4th. A lot to go through, but I'm going to whiz through it just like the market's volatility whizzed us through a massive whipsaw. And I also need to go through this quickly because conditions could change either while I'm recording this or as early as tomorrow's open. So let's take a look. For context, the last time I wrote on my blog, I claimed that the market wasn't oversold enough for my taste. And the first 2 days proved out my claim. So what happened for the first 2 days of this week? Well, um, Friday was a big fake out for buyers and bulls. The S&P 500 soared 1.6%. Oh, by the way, this is the Trading View charting program. And you can see on Friday, the sellers took over right at 50-day moving average resistance. That's that red line, and basically reversed all of the gains. S&P 500 lost 1.8%. Today's wild action featured a gap down, a test of the 200-day moving average support, which is very important. And I'll talk about that a little later. This blue line, this is a long-term moving average, extremely important as a test of the market's health. A rally to actually a gain on the day, and then sellers took over again and bashed the market back down to a 1.2% loss on the day. I have to go to the 15-minute chart just to show you how wild this trading action has been. This has been great for traders like myself who are, I just happen to be paying attention this week. But of course, for long-term investors, it's madness and, you have to look through it. So here's the 15-minute chart, which you can see here. This is what I was talking about, the reversal on Monday. Incredibly, buyers zipped into the market I think this was the last 15 minutes of the day. Actually, I thought it was more. I thought it was more like 30 minutes. But anyway, and then we gapped down and then we reached the bottom. This is, again, remember, this is where the S&P 500 tested the 200-day moving average. People don't think technicals matter, but they matter a lot. And, the machines or the humans or both jumped right in, right on schedule, and bought the S&P 500 up. It looked like I was going to be able to declare a confirmed bottom, but sellers jumped in right here. You can see these last 15 minutes. Sellers just overwhelmed any kind of buying action and took the S&P 500 back down to a loss on the day. Now, this 15-minute chart is also important to remember that a strong downtrend is in effect since what is this? Since February 20th, the market, the S&P 500 specifically, is in a sustained downtrend. This is very bearish short-term trading action. So let's go back out to the daily chart, and you can see here some more context. What I'm now looking at, given this breakdown below the 50-day moving average, is the potential for a kind of double or triple top, depending upon how you interpret the technicals. So overall, what I'm trying to say is yes, the trading action has been very wild. It's something to look through if you're a longer term investor, but there could be longer term implications here, especially if the S&P 500 does not hold this 200-day moving average support. I'm going to consider it a confirmation of the top and act accordingly. Okay, let's go to the NASDAQ because the NASDAQ has sustained even more damage. The NASDAQ actually has closed below its 200-day moving average. You can see the steep selling that's been in effect since late February. The NASDAQ is now even below the DeepSeek drama that I wrote about before. The NASDAQ's also in bigger trouble because its triple top is much more easily defined. Particularly in the middle here, you can see essentially what's an abandoned baby top, which is there was a gap up 3 days the NASDAQ held and then it gapped down. So a lot of buyers are trapped here and they still have not received relief because the next rally stopped right at that resistance. So anyway, all that to say is that the Nasdaq's break of 200-day moving average support is very dangerous here because it's on the verge of confirming a bearish breakdown and this double or triple top. Very, very very, very alarming or ominous. And now, of course, I always talk about the small caps. Small caps just look terrible. Of course, it gapped down, didn't recover. What you probably see on some of these is that there's some after post-market action. I think there's a reversal of those last 15 to 30 minutes of selling. So in the aftermarkets, for whatever reason, the buyers jump right back in. So this is why I said I'm trying to go through this quickly because conditions are very fluid right now and could change at a moment's notice because of all this tariff headlines and geopolitical news and on and on and on and on it goes. Now, the small caps look particularly bad, but they're trying to hold around this support from the September lows. But basically overall, the small caps is IWM, the iShares Russell 2000 ETF, has been very disappointing. I went into this year very bullish on its prospects for rebound, and that just has not played out. And in fact, technicals have really been in control of the small caps for some time now. Okay, so it can't all be doom and gloom, right? So let's take a look at the extremes. Now, before, like I said earlier, I wrote that the market wasn't oversold enough for my taste. Well, now it is oversold enough, and let me show you why. First of all, my favorite technical indicator, which in TradingView is MMFI, I call it AT50, which is short for above the 50-day moving average. It means the percentage of stocks trading above the 50-day moving average. And you can see on Friday when I wrote the market wasn't oversold enough, well, it was still in the low 40s, high 30s, and was nowhere close to the dip that it had seen just earlier this year. This is January. Today, my favorite technical indicator dropped all the way down to what is this? At one point, 26%. So only 26% of stocks were above their 50-day moving averages at one point. That's extreme. And even more importantly, it broke down below the previous close and almost tested the low of the year. To me, that's extreme. We had a bounce from these levels last time. So I am willing to switch my short-term trading call to essentially oversold. As you'll see when I pan out here, technically or more officially oversold is at the 20% level, but because we're in a bull market, I have to consider the possibilities that the selling just won't be aggressive enough to push market breadth down that far. Let's take another look at potential extremes, which is the VIX, which is the measure of market fear. Now, you can see here that at the highs, the VIX got close to the previous high, which was in mid-December. And if any of you were following, this is when the market got very disappointed in the Fed and Federal Reserve's monetary policy. I wrote about that on my blog, so if you need more details, you can go there for December 18th or 19th. But for now, the main important lesson is that volatility almost tested that point, so we're now close to a previous extreme. I would have preferred for the VIX to hold there to really confirm that extreme, but instead, volatility pushed back. So it's very possible. I mean, it's almost 50-50 in my point of view. Either the sellers come right back and push the VIX back up, or we're going to have a big implosion, just like we had a big implosion in the last peaks. In fact, all peaks, implosions of volatility follow all the peaks. So if I see an implosion of the VIX here, I'll again confirm that we've seen a short-term bottom. There's another way to assess whether we are oversold enough. And this is something I don't incorporate a lot, but it's the fear and greed index from CNN Business. And since I think end of last week or maybe Monday, their gauge has been reading extreme fear. Now, I won't go into all the definitions of it, but I just will pull up their timeline view to show how long they think the market has been in extreme fear. And this has been since the end of February. So this is to me an extreme fear because it is very hard for the market to maintain fear. That's just the market's mechanics. There's a lot of money that just pours in consistently without thinking into the market. And so at some point, inflows do overwhelm, and or you got a lot of people who say, hey, the stuff I wanted to buy a week ago, a month ago, a year ago is suddenly looking cheap, however they define cheap. Now, the last thing I'll note is that look at this. The fear and greed index hasn't been this low since last August. So there was 17 there, and it's now around 20. So again, we are oversold enough if you want to combine this fear and greed index with my AT50. So let's look at one last chart and then we can close this out. I'm going to look at the longer term market breadth indicator. This is the percentage of stocks trading above their 200-day moving averages. So this is an indicator of longer term market health. You could see now very clear that the market is breaking down underneath. Only 40%, 41% of stocks are trading above their 200-day moving averages, and this got down as low as 39%. Let's take a look at the last time it was this low, was all the way back at the end of November. And if any of you were paying attention back then, sorry, this is mid-November, this period was in the middle of a huge bounce back from a major historical bottom in October. I mention that to say that if we are entering a more bearish phase of market trading, AT200, which again is the percentage of stocks trading by the 200-day moving average, warns me that we could have a lot more room to go down. So while again, I think the market is oversold enough to look for things to buy for swing trades, short-term trades, and for you long-term investors for longer-term holds, this chart alone tells me to be careful that if further breakdowns happen, be prepared and brace for much bigger losses. So I know I had to go through that fast. If you need any more information, just ask your questions in the comments. In the meantime, you can subscribe to my channel if you have any, if you want to keep up with this content. And again, you can also read more details at my blog, drduru.com/122, all letters. And I will see you later. Thanks for checking in.